For many years, the idea of digital money lived in a small corner of the internet. A handful of computer scientists and cryptographers discussed whether people could send value online without using banks. The work stayed in research papers, mailing lists, and niche forums. Ordinary investors and the general public were not paying attention. That changed in 2009. A piece of software called Bitcoin appeared online under the name Satoshi Nakamoto. It combined older ideas, digital signatures, proof of work, public ledgers, into a system that looked like a new kind of money. The story around it was simple and powerful. Here was money that no government controlled, that no bank could freeze, that was managed by open code and a network of users instead of a central authority. The timing mattered. The world was still dealing with the fallout from the 2008 financial crisis. Banks had been bailed out. Homeowners and workers had not. Trust in the financial system was damaged. Against that backdrop, Bitcoin looked like an escape route, a way to step outside institutions that many people felt had failed them. As the idea spread, other projects copied the basic model. They launched new coins with new names, new logos, and new promises. Some talked about faster payments, some about smart contracts, others about digital worlds or Web3. Around them grew a new industry. Exchanges where people could trade the coins, wallets to store them, online communities to discuss them, and eventually millions of different tokens. The broad promise was clear. Crypto would be the future of money. It would build a fairer financial system. It would give ordinary people a way to protect themselves from inflation and from the bad decisions of banks and governments. On paper, it sounded like a revolution. More than a decade later, the picture left behind looks very different from that dream. Bitcoin was originally described as electronic cash. Measured against that goal, it has not succeeded. In daily life, most people still operate entirely in traditional currencies. They are paid in dollars, euros, rupees, or yen. They pay rent, buy groceries, settle taxes, and save for retirement in those same units. Only a tiny fraction of everyday bills can be paid in Bitcoin or any other coin. A small number of online shops accept it. Many of those do not actually hold the coins themselves. They use a payment processor that instantly converts any crypto received into standard money. They choose to do that because they do not want to carry the price risk. That risk is large. The price of Bitcoin can move 10 or 20% in a few days with no obvious trigger. For a landlord, agreeing to accept rent in something that can drop that far between 1 month and the next is not attractive. For a worker, taking a salary in that form is just as uncomfortable. The unit is too unstable to anchor long-term contracts. The network also struggles on their load. When many people try to use Bitcoin at once, fees to send a single transaction can become higher than the cost of an ordinary bank transfer, and confirmation times stretch out. Waiting several minutes may be fine for an occasional large transfer. It is not practical when buying food or paying for a taxi. Because of these problems, Bitcoin gradually stopped being marketed as a replacement for cash. Supporters shifted the language and began to call it digital gold instead. The comparison is weak. Gold has a long history. It is used in jewelry and in industry. Central banks hold it as part of their reserves. Bitcoin is a recent invention whose value depends almost entirely on the belief that others will continue to treat it as valuable. In real economic activity, most use of Bitcoin and other coins is not for buying and selling goods and services. It is for speculation. People hold them because they hope the number on the screen will rise, not because the coins are genuinely useful in the way that ordinary money is. Once it became clear that people were willing to pay real money just to own a digital token, a repeatable pattern appeared. A small team would publish a document describing a grand vision, a new platform, a new game, a new social network built around the new coin. They would create that coin at almost no cost, reserve a large share for themselves and early investors, and sell the rest to the public. On the surface, each project sounded unique. In practice, most followed the same script. The token was not truly necessary for the basic idea to function. It existed mainly as a thing to sell. If enough people believed the story and bought the token, the price went up. The creators could then gradually sell their large holdings to later buyers at higher prices. Websites that track the crypto market have listed millions of different coins. The majority of them no longer trade or trade only at negligible prices. They didn't simply decline a little, they effectively died. Their social media channels went silent. Development on their code stopped. The tokens themselves still sit on blockchains, but no one is interested in them, and no one wants to buy. After enough of these failures, a new pitch arrived: stablecoins. These tokens promised to stay tied to a reference asset, usually $1. The sale was simple. You could have the speed and programmability of crypto, but with a price that didn't swing wildly. Some stablecoins claim to be backed one-for-one by cash and short-term government bonds held at traditional institutions. Others use more complicated algorithmic structures, involving a second token and market incentives to hold the price at $1. As long as people trusted the design and flows were positive, the pegs held. When doubt appeared, some of those designs collapsed. One large algorithmic stablecoin that had been heavily marketed as safe lost its link to the dollar. The stabilizing token fell at the same time. Tens of billions of dollars of paper value vanished in this short period. Many people who thought they were using something similar to a digital savings account discovered that their coins were part of a large shortfall. At the same time, the pattern was the same as with the earlier wave of tokens. A product was created primarily to keep money moving inside the crypto world and to make trading easier and more profitable, not to solve a deep, genuine problem for ordinary users. To trade all these coins, people turned to crypto exchanges. From the outside, many looked like modern online brokers. They had bright apps, real-time charts, sponsorship deals with sports teams, and endorsements from celebrities. The image was of scale and professionalism. Inside, several behaved more like old-fashioned bucket shops. Customer deposits were not kept clearly separate from the exchange's own funds. In some cases, client coins were lent to related hedge funds or trading desks controlled by the same owners. Risk management was weak. Basic accounting records were incomplete or missing. When the market turned and prices fell, users rushed to withdraw at the same time. The cracks became impossible to hide. A number of large exchanges froze withdrawals or entered bankruptcy. Court documents from the cleanup described record-keeping so poor that administrators could not easily tell where customer assets had gone. People who believed they were using a safe custodian discovered that their coins were part of a large shortfall. At the same time, another layer of the ecosystem grew: decentralized finance, or DeFi. These platforms promised to recreate banking functions: borrowing, lending, and trading. Instead of a company taking deposits, a piece of code, a smart contract, would hold funds, manage collateral, and pay interest automatically. Websites for these projects advertised very high yields on coins placed into their pools. In a period when bank savings accounts paid almost nothing, offers of 10, 20, or even more % per year looked extremely attractive. Many users treated those numbers as if they were simply the result of clever new technology. In reality, those yields had to come from somewhere. Often, they were paid in new tokens that the platform had minted for itself. In other cases, they depended on the fact that the crypto collateral backing the system kept rising in price. As long as markets were going up and new users were arriving, it was possible to pay existing participants from new inflows and from unrealized gains. When prices flattened or turned down, the arithmetic failed. Some DeFi schemes were hacked because of bugs in their contracts. Others quietly shut down. Users found that withdrawals were paused or that the assets behind their safe yield had fallen to a fraction of their previous value. In both centralized exchanges and DeFi, users ended up bearing several risks at once: the extreme volatility of the coins themselves, the behavior and competence of the people or code running the platform, and the weak or unclear legal protections if something went wrong. The sense of safety came mostly from polished interfaces and confident marketing, not from strong underlying structure.
Thanks for watching. This is Global Flowlines. Subscribe for more videos.